So the best way to probably get an understanding for how we actually go about managing this rebalancing strategy or process is to look at an example. I've just got quite a simple example up here of a portfolio called the XYZ Portfolio, established in 2005. To keep it simple, we're just going to have two asset classes, shares and fixed interest, with $1 million to invest split 50-50 between the two asset classes, so $500,000 into each of those two asset classes. Now, before I get into this example, I just want you to bear in mind 2 points. Will the rebalancing of this portfolio increase the return? And secondly, will it reduce the level of risk? They're the two things I want you to bear in mind. So from the period of October 2005 to October 2007, the portfolio has grown, as you can hopefully see on this graph, to around $1.25 million in value. So this is a handsome 25% return. You may recall during this period that the share market also experienced great growth up to 2007, and although this portfolio wouldn't have captured as much growth as the broader share market, given it has a 50% exposure to fixed interest, which is reducing the risk. So now that our portfolio has grown in value, how does this affect our initial asset allocation that we set up? So given the strong performance of the share market, you can see by this pie chart that the share exposure has now risen to 60%. At the same time, the fixed interest exposure has remained constant at $500,000, but given the rise in the shares, the fixed interest exposure in percentage terms has actually fallen down to 40% now. So what are the implications of a 60% share exposure on our portfolio now? It's changed the risk profile of this portfolio. If shares are continuing to rising, well, then the portfolio will probably perform better, but at a much higher risk. So we've got to correct this by looking to undertake a rebalance. So the required action, we sell $130,000 worth of shares, and we reinvest this money back into fixed interest, or into fixed interest, I should say. So the benefit of doing this is we're reducing the level of risk of the portfolio. We're also locking in gains at a high point of the market. We don't really know at the time that it is towards the height of the market, but the rebalancing strategy is dictating that we must reduce this exposure, which gives us a natural sell high type of process. So we're going to continue on in the example. So another year down the track, we've now hit, from October 2007, we've now hit October 2008, and you may recall the share market didn't do too well over that time. So now, as you can see on the graph, the share market is valued, sorry, not the share market, the portfolio here is valued at around $1 million. So just to compare what the broader share market is doing in this same time period, from October 2005 to October 2010, the share market is actually down 10%. So our portfolio is at break-even point at $1 million. So by having this asset allocation with the two different asset classes, we've reduced the risk, and by rebalancing, we've also locked in some of those gains a year ago at a high point in the market. So that's also softened the blow, and the reason it's at break-even point rather than being possibly negative 10% or such. What is the effect of this movement now on our asset allocation? The share exposure now has fallen to 37%, and at the same time, the fixed interest exposure has risen to 63%. So once again, it's changed the risk profile of the portfolio. We're very much underweight shares and a growth asset. We need to change the risk profile once again. So we rebalanced the portfolio by selling $128,000 worth of fixed interest this time. We're doing the opposite of what we did last time, and we're buying $128,000 worth of shares. So like I said, we're doing the opposite of what we did first time, where we're essentially buying low towards the bottom of the market by sticking to this strategy. So to look at the final result, we've now moved on to October 2010. So it's 5 years down the track. The portfolio from this chart, hopefully you can see towards the back, but it's valued at around $1,090,000. So it's just a tick under 1.1 million, which is a $91,000 gain. Just for comparison purposes, the red line here shows what would have happened if we did not undertake those two rebalances. As you can see, it'd be around $60,000 less at $1,030,000. And finally, the green line here is the Australian share market, the broader Australian share market, and as you can see, this line is much more, it fluctuates a lot more, which shows the volatility if we had have only invested in the Australian share sector. So at the start of the example, I asked if you would consider, will this strategy increase the return of the portfolio? Well, the answer to that is yes, given the $60,000 extra that the portfolio has achieved by actually rebalancing. And the second question was, will we reduce the level of risk? And as you can see by the yellow line, it is much smoother or flatter than the Australian share market, which shows we've reduced the volatility of this, or the risk of this portfolio. So in this example, we looked at how we go about rebalancing a portfolio with several different asset classes. We can also rebalance a portfolio within a particular sector. So the next example we're going to look at is within the Australian company share sector. We're going to look at ANZ Bank. Now, by looking at the chart, you'll see that ANZ hasn't yet recovered from its heights of 2007. It did reach around $31 a share, and now it's trading at around $24 a share. So it's not quite back to where it got to at its height. I'd like to show you by way of an example how we're able to profit by undertaking a rebalancing strategy in a falling market. So I'm going to run through an example of an actual real life client. This is one of our clients where we initially recommended that they purchase ANZ in April 2007 at a $30,000 investment at $31.28 per share. Over the next 18 months, the falling share market provided some opportunities to top up this exposure and lower that average purchase price. In January 2008, another $10,000 was purchased at $25.95 per share. In October 2008, we suggested that this client purchase another $30,000 at $17.68 per share. And finally, in November 2008, ANZ put out a share purchase plan to the market, and we recommended that this client subscribe to their full allocation of $15,000 at $14.40 per share. So although this client initially purchased ANZ at $31.28 per share, by undertaking this rebalancing strategy, they've managed to lower their average cost down to $20.82 per share. So what does this mean? ANZ now, as I mentioned earlier, is trading, it's just a tick under $24. The close yesterday was $23.75. So this particular client has made a gain on this investment of around 14%. If no action was taken from their initial purchase back at $31.28 back in 2007, they'd be sitting on a loss of around 24%. Just to have a quick look about the actual rebalance process, once you've selected an asset allocation and an investment strategy, this should really be stuck to and monitored on an ongoing basis. At Hewison's, we'll review your portfolio all the time. Even if we don't contact you, we'll be looking at them. So this might lead you to the question of how often do we actually rebalance or make changes to an investment portfolio. This depends on a couple of different factors, including the size of the portfolio, the level of withdrawals or contributions to the portfolio, and the prevailing market conditions at the time. So just a couple of examples around how often we would rebalance. The recent tumultuous market may have provided more frequent opportunities to rebalance over the last 2 or so years. Such as that example I just provided with ANZ, we probably undertook more rebalances than we usually would because the opportunity was there. Or another example, a client making regular contributions to the portfolio, we may look at more often given we've got to invest this money according to their asset allocation. Just a couple of other points to consider when we're undertaking a rebalance. The transaction costs. Each time you purchase an investment, you pay a transaction cost. So for Australian company shares, this is a brokerage fee. So excessive rebalancing can eat into the investment returns of a portfolio. So it's something that we must consider and make sure we don't do it too much. And taxation consequences is also very important. So for example, the sale of an investment may have a large capital gains tax liability, or it may even be in a loss position. So before we actually make the decision to sell this, we really have to think about what the implications are going to be for the client. There may be an opportunity to delay it for a year until retirement, or a year where they're earning less taxable income. So just in summary, I hope this presentation has shown you the importance of setting an asset allocation at the start, and how the ongoing management of this asset allocation, or rebalancing, is imperative to continue to meet the goals of your the goals of your portfolio, and to maintain that level of risk at the right level. So I want you to remember that it's not set and forget. So the next time you might hear from us at Hewison's that your portfolio is in need of a rebalance, we're probably doing it to bring your portfolio back into line, like I've shown you today, and also to maintain that level of risk. So thank you very much.